Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Very often, or more often than not, our conversations meander around what is the equity setup looking like, what are the themes to bet on, and how could you play these themes, what are the upsides and the downsides thereof, which is par for the course. Once in a while, we try and invite guests like the one that we have today on Talking Point, Mr. Maneesh Dangi, talk not about the micro at all, but focus entirely on the macro setup, because it gives an inkling of what the top-down view on investing, India investing and global investing could be, and the different facets which may impact all of these and the interlinkages thereof. Let's get him on the show again. We don't get him too often, but Maneesh, it's a pleasure having you.
Yeah, pleasure mine.
Okay.
Thank you so much.
So Maneesh, starting off, how is the and we'll encompass everything. I would love to talk. Give us some time. I would love to talk about what do you make of the budget? What do you make of the global macroeconomics, and how does it impact local as well? But just broadly, to start off the conversation, how is the macro setup looking like? Is it weak? Is it bleak? Or is it not so weak? Why or why not?
No, from an absolute standpoint, economies across the world are chugging along pretty well. As we anticipated, post-COVID recovery, huge amount of stimulus, both fiscal and monetary, has led to a fairly sharp recovery, almost unprecedented, and not many would have baked it. The side effects of stimulus are in now. So to that extent, you have inflation pretty much across the board. You can see different gradients across, but whoever actually overstimulated, as most Western countries did, you sort of get to see a significant inflation. You also have, some of the countries, such as US or India, for a variety of reasons, a lot of demand slipping to rest of the world. So current account deficits have actually have risen in many of these countries. Of course, correspondingly, some countries who didn't stimulate or were manufacturing powerhouses like some of the East Asian countries and China, current account surplus has risen. So in a sense, balance sheets are sort of looking pretty different. Household balance sheets, in most of the West, because of very large stimulus, direct transfers, again, some sort of a DBT, were done, and they're sort of pretty cool. One of the best in last 15-20 years. Wealth has, of course, risen dramatically, and so to that extent, people are drunk, in wealth. That sort of gives a good setup of perhaps a longish recovery. But as we all know that there is cyclicality in everything. So when you are drunk and then there are after effects. What happens, of course, is that these hangovers happen, and this is what precisely is beginning to happen as policymakers now begin to focus on the side effects, such as inflation, such as current account deficits. They're trying to obstruct economies, which is perhaps something that some of the risk markets are not liking. Low for longer regime expectations on interest rate is being questioned at many places. So that's the setup. Okay, from a big macro, it's not red, not green anymore. It's sort of an amber setup where underlying momentum is pretty strong, but then that momentum is resulting in some side effects which are perhaps detrimental to even and longish recovery, and which is why policymakers are leaning against the wind now. So that's the argument that we've had over the last 3, 4, 5 months, that this ought to happen, and which is precisely is beginning to happen. So purely from asset market point of view, we'll discuss later, but it's not about the absolute level of macro, but the delta of it, and if it is turning for worse, asset markets, of course, don't like it. Bonds don't like it. So that's the big picture assessment.
Okay, since we'll talk about assets markets in a bit, I'll change my follow-up question. Let me try and stick to the macro setup. do you think, in your assessment, that the markets are underappreciating what the impact of, whether it's 3 or 4 or 5 or 7 rate hikes in the current calendar? And of course, the probability, because a lot of people question the Fed's ability to do that simply because of the levered nature of the US corporate balance sheet. So that is part one. And therefore, do you reckon that that there is a possibility in your setup of a surprise up the alley, or do you reckon that there won't be a case for a surprise? Whatever is out there is now kind of discovered. Yes, it could have its impact, but there won't be a surprise in that sense.
So, Neeraj, let's take a small step back and look at the global rate setup. Okay, and there, of course, the dominant conversation is going to be about G7 economies and primarily US. But the thing is that it's the first time Fed, BOE, and many other central bankers have to tighten to regain their credibilities, and also the first time that there is actually a political pressure to hike instead of loosening it. So let's get that basic conceptual framework right, that it's a different setup in which after good 30-35 years, when central bankers have rolled with a lot of credibility, there is a question to which what they practiced, and which is why they are now sort of beginning to do something very different. So there is a very low probability I would assign to these technocrats, who would let go of this opportunity if there is a political will to actually act against this wind. Second is that, it's the first time again in last 20-25 years that there is a tightening financial condition, tightness in progress when the delta growth is actually turning for worse. You think of anything like consumer confidence or retail sales or many indicators, they're actually turning for worse. And yet, you see fairly hawkish commentaries. So you have to understand that the template seems to have changed. Given that the Fed, BOE, and many others actually made one side of error, Neeraj, over last 10-15 years, which was to keep rates too loose instead of too tight, my fear that the path of least resistance will be to err on the other side. Also, it's important from market's point of view to actually digest this fact that there's going to be no QE for a long time, and the story of MMT, which was sort of much talked about ahead of the crisis, that it would come in rescue. Since we already know the side effects of MMT, especially in US, I think it would not be practiced. So no QE would mean that risk premiums, which were somewhat elevated, would have to be questioned. And then finally, the most important central bank, which is Fed in the world, is extremely academic. I think Fed thinks a lot less of markets than market think of Fed. Okay, and they don't bother much about market. I think, as many want to claim it, that the strike price at which Fed would actually turn again, as far as equity markets are concerned, is much lower. I think the financial stability, inflation stability is much important today than anything else, and which is why I would argue that while markets have come around to actually believe the thesis that I would have presented you back in August as well, that they were behind the curve, central bankers were behind the curve in accepting that inflation is a pretty big sort of evil right now on the radar. Central bankers have accepted it. The fact that the twos in many countries have risen by 1%, your mortgage rates have risen by 1% in last 8-10 months, means I can't now anymore claim that markets are ignorant of it. But I won't say that markets are overpricing it, and there is a momentum in every trade. My fear is that rates would still harden because they would still be confronted with relatively hawkish Fed. As I argued that the place at which Fed would actually respond to markets turbulence is much lower than what many would like to believe in.
So your argument is that, quite unlike the belief that people had, a lot of people had, that if the markets crack, then the Fed will come to the rescue. Jerome Powell has done that all through 2021. You are saying that the Fed was actually not playing to the gallery from the market's perspective. It was just behind the curve on inflation. And now when it acts and when it's got a chance to act against inflation, it is not going to make comments which will necessarily in order to soothe the markets. Fed will do what it does, irrespective of what the markets are.
Yes, yes.
Okay, great. My follow-up question to this would have been an asset market question, but I still want to get a couple of other macro questions out of the way first, Manish. The third bit is in light of the possibility that we are in an increasing rate regime wherein the political will is also supporting that. And at the same time, we have, let's say around the world, leave India out, but around the world, growth on a year-on-year basis as well might come, if not to a standstill, then slow down quite considerably. But we might still have rising commodity costs to contend with, oil in particular. And if China wants to stimulate growth ahead of the November event, then that also keeps commodities elevated, presumably. How does that narrative impact growth versus the inflation dynamic? And more importantly, for economies which are net importers of commodities and therefore are running reasonably large or largish or becoming larger current account deficits.
So Neeraj, moderate inflation with sort of a neutral to positive rate setup actually facilitate reasonable growth and risk taking. But contrary to what many believe, that inflation is actually good, it is perhaps good in near term, but it actually takes purchasing power away from consumers. In the end, it's a TOT adjustment. And my fear is that inflation has run too hot for too long in some countries, more specifically in US, to have actually robbed a lot of consuming power. Okay, and so to that extent, I think, at least in my mind, basically a lot of consumer surplus, which is assumed to be there, okay, in many of these countries, perhaps may not be there. Okay, that's one. Number two is that in the growth narrative of medium term, many believe that consumer surplus, the savings that a lot of people accumulated because of the transfer from fiscal, may not be out there to be spent, because people underappreciate that after this once in a century health crisis, people would not alter their behavior. It is very likely that when we confront as human beings, something catastrophic, it's very likely that we may change our behavior to the extent that there is more precautionary saving than, we would otherwise have in, relatively sort of a soft setup, that we all generally tend to live in.
Manish, sorry if I can interrupt. Isn't there evidence to the contrary? The Great Resignation theme shows that the US consumer, for example, is not quite being precautionary. If anything, he's letting go of, or she's letting go of her income in order, because of the income transfer advantages or what have you.
Yes. So basically, the first action, what we've seen is that they did dip into the savings. Okay. And then thereafter, what we began to realize over the last 3 or 4 months, given the retail sales data in US and many other countries, is that it is surprising on the downside. Why many market participants and economists have been surprised on the data, while it is in absolute terms is fairly strong yet, is because the assumption was there that the excess savings that Neeraj, Manish, and many others accumulated, okay, through the pandemic would continue to be splurged. That's not happening.
Okay.
Which is why I am actually taking a step back and saying that, please do take care of the fact that, this big crisis may have actually altered the behavior. Exactly this happened in GFC also. After the great financial crisis, the consumers actually never levered to the extent they were doing in the pre-GFC setup. So I would argue that along with many other, fundamental and structural traits which are in play right now, we are aging economy, sort of a place in most big nations are aging. And when they confront something like this, where they say they see their friends and relatives going through some trauma, I wouldn't be surprised if actually take a step back and say that, no, let's not, let this be that, few $100, $1,000 could be saved for some emergency. Okay, so that's the second part of the narrative, that it's not very clear to me that despite sort of household balance sheets relatively clean, but when I say relatively, it's only relative to last 15 years. Okay,
Sure.
savings actually in many of these developed economies used to be, especially in households, used to be much higher back then. Okay, but because of whatever culture and this is what capitalism does and advertisement business and everything, this and of course improved social safety net has led them to sort of lever up more. But my argument is that they perhaps may not lever up.
Okay,
Okay.
sure.
But then, for countries like us, and many other like Europe and China, I think the big mess actually is oil. Okay. Which is while, at a household level, it's fine, but because we spend 10-15% of our income on transportation. But the problem is that, as a country, we borrow far too much from the rest of the world to buy oil from Arabian countries, right? And we can discuss in detail there, but my fear is that um, uh, Neeraj, I want to make this point. I think I've shared with you earlier that most of the past bursts in the world have happened because of the energy scares, be it of mid 70s or early 80s, Iran war, the Gulf War of 90s. And then I actually argue that even 2008 sort of collapse was more than housing, was an energy scare. So my point is that, the setup in oil, is such that it could continue to stay elevated. I mean, that's been my bet throughout 2021. And I still think, while it's overheated right now, I still think that the setup for oil is such that it could continue to bleed us and many other countries, which perhaps is a fear I have, that not only, post-COVID recovery could be shallowish because of the reasons that I mentioned, but oil could perhaps be an extra trigger to sort of prick the bubble that we have right now, economic bubble, I mean.
So you reckon what kind of an impact would it have on the macro and how investors view, let's say, for example, India, because of one, the commodity price inflation and what impact it has, versus an argument that people have that, and I'm bringing in a bit of an asset markets query in here, that the argument that people have that what the macro does versus whether growth kind of takes over, because India could be one of the very few economies which could show, even if it doesn't show 9%, if it shows 7%, it still would be that one large economy which is showing some growth vis-a-vis China and the US and some of the others stalling in 2022.
No, I mean, okay, let's get the context of India growth first. Before we get carried away by these dazzling numbers of 8-9%, is that India perhaps is the only economy, which would be so much below pre-COVID trajectory. No other major country is actually in G20 or many others would be as significantly worse off relative to pre-COVID trajectory. Okay, so in a sense, even though we would do reasonably well this year and next, by FY23, we would still be about 7% below pre-COVID trajectory, relative to US, which would be sort of pretty much there. In a sense, pre-COVID trajectory essentially means that had COVID not happened, in FY20, 21, and 22, we would have grown at, let's say, 6.5% or 6%. So we would have been about 20% bigger by FY22 end, but we would only be about 12% bigger. So and for US, and many other countries, the recovery has been fairly steep. So it is true that we are recovering from woes of COVID, but our recovery is incomplete relative to most of the West. And which sort of brings me to another problem, that typical emerging markets, which are late trades, we go through it, that when many Western countries and more specifically US recovers, it embarks on tightening. It tightens financial conditions far too much, and that results in setup becoming antagonistic to our economies, and we are generally not able to recover from the crises, such as COVID or many others. I'm afraid I wouldn't play to the tune that we are doing bombastic. Just to sort of clear the fact, if I think of 2018, 19, 20, 21 together, all 4 years, we've grown at 3%. Versus the pre-COVID trend, which was, let's say, 2010 to 17, we were growing at about 7.2%. So we are actually 4% below in last 4 years cumulatively, 4% every year below the pre-COVID trajectory. That number is not as big. Let's say for Western countries, from 1.7% pre-COVID, they're about 1%. And for most emerging markets, they're about 2.5% below the pre-COVID in last 4 year cumulative. So in a sense, our economy is fairly scarred for a variety of reasons that, we can discuss. And I think we need a relatively soft regime. We don't need too high in oil, too tight financial conditions, because on our own, we would not be able to recover pretty fast, despite the fact that, there are a lot of good things in economy as of right now. Most specifically, our balance sheets are pretty clean, both banking balance sheet as well as corporate. But yet we need enabling conditions, from outside world, because we're not in isolation. We are fairly interconnected, and we need a lot of risk capital from the rest of the world. And I'm afraid, if the setup actually outside turns worse, viewing it microscopically, just simply sort of focusing on local economic factors, may not yield much to us.
Yeah, so it's very likely, Maneesh, that based on whatever we are reading, that oil prices, and would love your view. You already kind of shown your hand that you believe that oil might stay stronger for longer, even if there might be a bit of a dip because as you said, it's overheated or what have you. And again, I think it was a Morgan Stanley note which said that they believe 120, BOFA was 100, and some others might be even higher. I mean, Goldman Sachs, I haven't seen the latest, but it could be at 200 for all you know. But be that as it may, the point being, if oil stays stronger for longer, if liquidity conditions outside the world, around the world dry up as well, and growth in general kind of slows down, the enabling conditions are not there. How do you think then India as an economy does for the better part of 2022? What's the hypothesis?
So I think, as many sort of love to argue that India sort of disappoint both, too pessimist and too optimist. My sense is that it's a sort of a middle of path Buddha way. In 2022, we would still secure, I would say 8.5%. But do not think of it. I only want to emphasize that this is not the 8% that we know as 8%. It is simply recovering some of the past losses, which have been pretty dramatic. We haven't seen such dramatic losses relative to the trend growth over last many number of years. Even 99, 2003 was not as dramatic as we've seen in last 4 years. So we would recover most probably. I think there are many good things in place, as I said, which is the most importantly that the risk-adjusted capital of our banking sector after very long, since 2009, is pretty good, at 16.5%. Our corporate balance sheets are pretty good. The operating margins have risen from 14% to 18% for wider universe of 2,500 firms. Interest coverage ratios have improved from 3.5 to 5.5, again for the same set of firms. Our inflation, though, has been somewhat high in last 2 years, has been still moderate relative to most other Anglo-Saxon economies and some of the Western economies, which has seen 30, 40-year high inflation. There are no great excesses as far as our debt is concerned. No bubble, so to say, in property and such likes, which sort of invariably become Achilles' heel for many economies. So I think there are a lot of good things, Neeraj, which would secure us next year 8.5%, but more importantly for rest of the decade, somewhere close to 6%. Okay, so there's going to be disappointment for people who sort of want to rehearse this as if it is as if a 2003-8 sort of is going to dawn upon us yet again, and they will be disappointed. But then people who sort of think look at 2018-21 and then argue that that's the template of India's growth and we sort of are already in middle income trap, there is a news to them that it's very likely, India is fairly resilient economy. Over last 25, 30 years, we've been able to clock about 6% growth, give and take 25, 30 basis point here and there. But, we are able to secure that is because of our demographics, because, enterprising setups that we have, our quality and economic policies, not as great as, you would imagine, in some of the East Asian countries, but it's fairly good. I mean, how many people actually remember the BRICS, where all the other BRICS of the BRICS have actually disappeared except India and China, of course.
Yeah.
So I think disappointment for both sides, but in near term, just to conclude, I if we want a sort of acceleration, we need confidence back. We need household balance sheets and Indian industrial capex to sort of return, which has been missing for a long, long time. And one of the reasons, so while the corporate balance sheets are pretty strong, the demand recovery in India, may not be as strong. But unfortunately, we cannot stimulate demand because the binding constraints for the economy are already there in of 6% inflation and 3% current account deficit. So we'll have to. It's an extremely sort of a delicate task of actually doing. Just a minute, Neeraj. Extremely delicate task of actually stimulating parts of economy where the excess demand does not slip to what do you call rest of the world. Okay. So my thing is that if the policy and the budget had treated housing, which I think a large part of housing is actually all about, Indian stuff, that we prepare, we make and manufacture, and construction and stuff like that. I think I would have been happy, but that is a part, perhaps even though you may stimulate, may not result in high CAD and high inflation.
So you think the budget missed a trick? Because I mean, again, okay, let me put it this. Let me rephrase. While there is skepticism around what the number on the capex front is, there is no denial to the point that there is a push on industrial capex from the government side, arguably because maybe the government is realizing that private sector is still not coming in and may not come in for the next 6 to 9 months. So they have gone for the approach of not veering towards consumerism, but in fact investing in capacity creation so that there are jobs. And maybe it is a delayed gratification, but at some point of time, all of that will come in and private sector eventually comes in, so on and so forth. Is that a valid argument, or do you think the budget misses a trick or two?
No, I think, there's very limited space that a budget, of a country like ours has, which is actually already at 90% public debt to GDP, a country which spends 40% of its revenue in simply paying back interest to people who it has borrowed money from. Most of the developmental expenditure this country does, by borrowing, it's not the revenue, irrespective of what people weave stories on tax policy, it is still, just close to pre-COVID level. So it's not. So in a sense, your finance minister doesn't have the wiggle room that many people would like to argue. But then this budget has shown some form of unusual fiscal aggression, I would argue. One of the reasons is political, because after Jaitley gone, I think the only fiscal hawk in the government is gone, and which is why we've seen, relatively sort of a lean. I mean, in terms of fiscal discipline, it is somewhat less. Now, sort of before getting to the capex push of government, the setup, Neeraj, is that a country which is perhaps going through is going to experience a 3% current account deficit, okay, which basically means nothing but that we are actually going to be consuming 3% more than what our income is, from rest of the world. We're going to borrow that money and spend. It's pretty high, it makes the setup look like 2018, if not 2013. A country which already has 6% inflation, which is close to the higher band of what RBI's mandate is. And then on top of it, when you introduce a fiscal deficit of 10.4% in aggregate, between state and center, that's like 3.5-4% wider than pre-COVID trajectory. So basically, what do you mean by when, fiscal deficit is high? What it means is that, from thin air, government is going to create more money because banking system is used to do that and spend that money. Now, as I argued in the beginning, that the binding constraints are that when you're already borrowing from rest of the world, to the extent of 3%, is likely, okay, in FY23, and your inflation is already at that 10% level, 6% level, the extra fiscal deficit, could this, and my fear is, there's a best case scenario that it actually goes in increasing capacity utilization, which is still abysmally low.
Yes.
Okay. Because if I had told you that a country is experiencing a 3% CAD and a 6% inflation, you would have actually concluded that our current capacity utilization most probably would be close to 75-80%. But it's not, it's near 70. But then, so which is why the best case is that, all of this excess expenditure of, let's say, 3-4% of excess fiscal deficit goes into making, capacity utilization of local improve. But what if it slips to the capacity utilization of Chinese? That would simply mean more CAD. And, we simply can't afford it because, it's flashing super red right now. So, I mean, my base case is that, in the current macro setup, unless this spending is well modulated, okay, and very, very targeted, any aggregate measure of spending more would always slip to more inflation and more CAD. That is what precisely you've seen in last 2 years as well. Now, going back to the original point of yours, that whether capex that the government is trying to project, I'm happy with the numbers. Of course, markets, as they always do, overestimated the amount of capex. It's not in 30s, but it's more like 15-16% of increase. But that's super good. But a small line of caution there as well, that capex generally tends to be import intensive, and which essentially means that that if we actually do so much more, the first order reaction function would still be more CAD. So what I want to highlight, Neeraj, here is that is the point of 6-8 months. 5-6 months, I've argued that despite your being absolute good, there is a difficulty of being good right now. Because the rest of the world is not supporting. We didn't dial for $95 of crude, but it is, as a matter of fact. And in that setup, we didn't dial for a K-shaped recovery that we ended up having, which meant that there were more iPhone sales, whereas restaurants struggled. Okay, that's because people like you and me actually perhaps saved much more than my average balance sheet of household. We ended up buying stuff which is pretty import intensive, and therefore much before we recovered completely, our current account deficit started to flash red. So in a sense, it's you are going to get a very clear super bear and super bullish argument on macro. My thing is that if we misjudge things, then it's likely that we will get into some sort of stress.
Well, one hopes that there is targeted spending, and some of this, if not all of this, doesn't go into the global capacity utilization and comes to the local ones. Maneesh, just 2 pointed questions and then asset market questions. One, in some fashion, with the PLI schemes, with software exports, and I know you have a very interesting view that I would love you to speak about that too. In its own way, in a slow way, I mean, we're an elephant, we take time to move, but there is some bit of, if not heavy export, then import substitution that India is starting to do at the margin. Is it enough, or would you have hoped for more? And can that, if not in 2022, then in 2024 maybe, come to rescue India? The import bill might be less, maybe the export export efficiency moves up in sectors like IT or chemicals or auto ancillaries or textiles for that matter, could that be beneficial in 2-3 years time, if not now?
Yeah, so I mean, I've had interesting arguments with people who've sort of been proponent of this, software boom. Nothing to sort of take away from the fact that our country has done phenomenally well over the last 20 years. From sort of zilch level of exports back in late 90s, early 2000. About 3.5% worth of GDP is what we earn, by exporting to the world. But then, when the problems begin to occur when you sort of extend this argument and then sort of make it an umbrella argument that no, this is the savior of ours, and can protect us from all catastrophes, which is one is underway, which is oil's rise. The fact that the software exports, as a percentage of GDP, have pretty much stagnated at about 3.3%. Now it's huge, but still just about 3.3% since 2003. Okay, so given 15 basis points, because of the sort of GDP movements, less due to a software export movement, these numbers vary, but they're not sort of off the mark anytime since then. Now compare this with the oil import bill of ours, which is at $90, it's about 4.5% of GDP. So basically, there is still a significant deficit, relative to, I mean, just to sort of, we are actually exporting the high-tech stuff, in terms of software services. And here we are borrowing from the rest of the world, or buying from the rest of the world, the oil. We still sort of are net paying 1.5%. Now, once you throw in another variable of invisibles, which is actually remittances, then story starts to look further worse, because our remittances had stagnated and actually started to fall, even though our GDP continued to rise, and therefore, as an absolute percentage of GDP, they've actually fallen. So once you sort of adjust for remittances also, so remittance plus software minus the services that we import, that's about 4.8% of the GDP. So of the $100 of GDP, 4.8%, $4.8 worth of GDP is what we net export in terms of services, be it people or of the software. You get it? Whereas, whereas oil bill is about 4.5%. So just 30 basis point saving, which is one of the lowest in last 10, 15 years. So there are 2 points I want to highlight here. Neither there is this sort of software boom which is in play right now, relative to what many think, nor there is a lot of cushion as far as invisibles and software together, from the oil stress that we have.
So I take on board your point, but since there is a corporate after corporate giving me the conversation of how they are starting to see global customers come to them. We've seen a couple of global, I mean, it's a small pocket, but in chemicals, right? The fragrance giants of the world set up and buy stakes in Indian companies, set up plants here. So that's happening in chemicals. We've seen textiles made starting to happen. Can that show some promise for the future, or is the number too small and too much at the periphery?
I'm afraid the numbers are. See, we are a giant economy at $3.3 trillion for FY23. Lots of moving parts. So it's absolutely phenomenal to see some plants here and there actually growing too well, and in the fragrances of certain flowers. But in aggregate, is the business of mine. It makes very little difference.
Very little difference. Okay, fair call. So Maneesh, then 2 questions before we wrap up. One is, I'm just trying to put a thesis out here and trying to understand what kind of an impact on asset markets could this have. Actually, would love to understand from you how our asset markets place currently. You've been kind of skeptical for a while. What happens now? And just a setup that if indeed yields globally were to inch higher, and commodity prices stay elevated the way they do, what kind of an impact, sentimental or otherwise, could it have, a further impact could it have on asset market, Indian equity markets per se?
Yeah, because for the equity, you have to plug in something like local rates as well. And I made this argument for a good 8-10 months now, almost throughout 2021, that India rates are headed higher. We're already near 7%. There is a fundamental construct that I've argued, which is high inflation, high US treasuries, and high current account deficit would result in high rates in India. So some of it is actually has played out. But then, we are in a little bit of a mess as far as bond markets locally are concerned for technical reasons. There is this serious issue that just about when RBI is going to turn bearish, or rather is not going to tango with finance ministry because the objectives are going to be different. You are confronted with 10.4% of fiscal deficit, which basically means almost about 17 odd lakh crore of net supply, facing you. That's near 100% of NDTL, or for common, understanding, let's say aggregate deposit. So all maths sort of point to a good 3.5, 4 lakh crore, or perhaps even higher deficit in terms of the gap between demand and supply of Indian bonds. Okay, so my fear is that in rates, we may end up getting into a setup which we are not very comfortable with. So far, RBI has done a phenomenal job in actually navigating rates market well. Despite fiscal dominance, rates have actually behaved pretty well. But my fear is that given that there is inconsistency now between fiscal stance and monetary stance, incrementally you'll hear it now in monetary policy, my fear is that there is a possibility of actually rates spiking, substantially more. I continue to stay bearish on interest rates, as I've been throughout 2021, and I wouldn't be surprised, if you actually get, state loans and 10-year PSU bonds at 8% in a couple of months' time, which is about 50-60 basis point wider. Now, why I argue local rate setup ahead of asset markets, is because I want to sort of give you a sense that in the end, a risk-free asset is going to be made available to you at 8%, sooner. You ought to be careful in pricing assets, even local assets, in a manner that you do, because they are actually pairs, right? It's not an absolute call just because you love a management in a firm, buy it at any price, which of course is an obscene idea. You ought to sort of compare this with all available opportunities, and do a risk return trade-off and accordingly place your bets. So which is why it is in next 3-6 months you're going to have opportunity to actually dialing risk in bond markets, and perhaps they'll begin to look pretty attractive, as well as relative to relatively frothy equity markets. Now on equities, I've made this argument since August, that the macro setup is going to get worse. My chief arguments were that oil and financial conditions, both will tighten. Both would actually put binding constraints on India's macro economic growth and eventually profit. India's profit cycle has actually surprised most analysts, but that's true for all countries' profit cycles. Okay, that they've actually done wonderfully for a variety of reasons, but more specifically low interest rates, low real rates, and fiscal play over the last 1.5, 2 years. But then some of the, and I want to sort of make a small, before the financial conditions argument, I want to make this point that as far as India's profit cycle is concerned, uniquely, it actually benefited from some of the positive shocks, at least the top 300, 400 firms. The demonetization and GST led to formalization. The tax cuts of 2019, of course, gave a kitty of profit to, with one stroke from finance ministry. The COVID led to sharp cost cuts, resulting in, fairly significant, widening of profit margins. Again, something similar has happened across the world, especially the COVID-related cost cuts. And the real rates have been sort of pretty depressed over the last 2 years in India, again, benefiting Indian profits, or Indian firms, big firms' profit. There has been a positive external shock because our 1.5%, 2% of, or rather 2.5% of CAD, current account deficit, flipped to near surplus last year. So all of these have been sort of 4-5 positive shocks. Some of them are actually waning now. The negative rates are giving into relatively positive rate regime as rates are tightened. The fiscal deficit expansion is actually going to give into consolidation. And the income squeeze that you had, the income transfer from labor to corporate actually is now going to be reversing. And current account deficit is actually widening. So remember this, that when a country pays a lot to Saudi Arab and Iran to pay for oil. Where is it paying from? It is actually in aggregate terms, it's paying from profits, either of households or of corporate. So my fear is that the lot of tailwinds which were one-off in India, okay, exacerbated by COVID shock, they are on their way out. And therefore, my thesis is that the profits which are about 3.5%, 4% wider today, the operating margins, would actually mean revert. Some of it would be durable, but mostly mean revert in next 1 or 2 years. So that's the sort of fundamental constructor on any equity, including Indian equity. But the macro argument that I have had, which is that tight financial conditions in oil, okay, are too obstructionist for risk taking, especially in times when then markets are not too cheap. I have never been part of the gang, of Jeremy Grantham and such likes who've argued forever that it's in bubble. I don't think Indian markets are more than 10, 15, 20% expensive at aggregate level. But if the macro turns worse, they can actually become cheaper than what they are today, from a baseline. So which is why until, this macro setup, turns benign again, I still continue to argue that, you must sort of stay underweight equities.
So in which case, what's the asset allocation? I mean, do bonds, do interest rate bearing instruments provide a serious alternative to the TINA argument for equities in 2022? And what would your asset allocation be per se?
Okay, so I don't have here and now arguments, yet. I mean, I've argued for cash, and I've argued against the idea being propagated by marquee fund managers that cash is trash. So it's kept me in good stead so far. It's not very difficult to earn reasonable return at cash only if you sort of allocate in some of the small finance banks and stuff like that. You can earn 6-7%. But now bonds are actually beginning to offer a reasonable alternate. I wouldn't argue overweight bonds yet, but the case of short bond has gone now. I think in 3-6 months, if you're ready to patiently wait with me, you would get 7.5% on 10-year India government bond and perhaps 8% on state loans. That's a pretty neat deal. You always make money, not just by carry, but eventually capital gains, because when the rates turn, these things rally by 1%, and therefore in price terms 7-8%. So I think for passive guys, I would say that it's time to be now equal weight bond. But for active guys like me, wait for 6 more months. As far as stocks are concerned, there are sort of, as I've argued on your channel many times, one are those passive allocators, really do not want to time markets. My recommendation continues to be that if you're a passive guy, avoid all fringe stuff, active stuff. You cannot, ideologically, you cannot have both timing and selection, active. Both have to be passive or both have to be active. So basically, if you're not timing markets and systematically investing, then you ought to be buying passive. Now, passive does not necessarily mean just index fund, don't get me wrong. Anything which is well indexed, any diversified mutual fund is also fairly well indexed because it's calibrated to larger indices, but not a time, as I've argued many times, to invest in small cap, sectoral, because if you're passive, then, who knows what rotation sort of markets will play and eventually devastate you, at least in near or long term. For purely a timing guy, Neeraj, I would wait for the regime change, okay, and be underweight or sort of cash. As I argued that macro is still sort of amber, energy scare and tight financial conditions driven by inflationary surprises is still in play. Okay, exactly that 5-6 months ahead, we've surmised, is in fuller force today than what it's ever been. And stocks are still sort of, even though 5-6 months have passed, they've put on 6-7% since then, since I've argued against it. So they're still expensive. So they're not sort of, from a baseline, they're not cheap. So I would still wait for regime change. before dialing risk again. As you sort of, we discussed, earlier that, I belong to a group of investors who do not consider that it's a law that stocks are risky and bonds are riskless assets, and therefore stocks are obliged to beat bonds across time frames. I mean, the very idea that was produced by Jeremy Siegel, way back in 90s. I believe that it's a regime which determines what risk is awarded. Okay, if there is going to be a whole lot of inflation, it is catastrophic for bonds. If there is a whole lot of deflation, it is very bad for stocks. Okay, and in certain macroeconomic regimes, stocks do reasonably well, as they've done in last 30, 40 years. In certain others, they don't. But it's never ever wise to believe ex ante, meaning ahead of any time, that it would continue to do well. So it's always, for people like me, we always like to wait for breaks so that, markets move from over optimism and underpricing risk to fear and overpricing risk. So those are the setups, which you get invariably 3-4 times at least in a decade, where you can double, triple your money within 1-2 years, 3 years. So I guess, I would still wait for break.
Okay. Maneesh, always a pleasure talking to you. Thank you so much for the time today as well, and lovely to get some of your thoughts on the global and the local macro.
Pleasure talking to you as always.
Thanks, Maneesh, and viewers. Thanks for tuning into this set of The Talking Point.